Hello traders, to another global macro update. We're going to be going over gold, silver, some commodities there, gold and silver ratio, and also going to take a look at the S&P and how we're potentially looking to profit from the next leg down, looking at an instrument that is called TVIX. We made a quick TikTok about it, and a lot of people seemed like they were interested in wanting to know more about this instrument that we use. So we're now going to dive deep into what we're looking for within the price action, so we have a high probability situation of getting that nice entry before the next move back up to, it went up to $1,000 last time. We'll dive into it, but first I want to discuss some of the fundamental news happening within the world. We're a team of Canadian traders, so we're going to quickly talk about Canada actually putting interest rates to close to zero. Bank of Canada cuts rates to 0.25% in another unscheduled move. So this was an unscheduled decision to try to stimulate the economy. Let's dive in here. The Bank of Canada cut its key interest rate by 0.5 percentage point to 0.25% in an unscheduled rate announcement Friday. The central bank said its decision to lower rates is aimed to cushioning the economic shocks from COVID-19 and a sharp drop in oil prices by easing the cost of borrowing. So Canada is not only having the difficulties of the COVID-19 virus, and they're not in full lockdown yet. Ontario is worse than BC, but obviously, like many other countries, we're seeing a huge economic downturn from that. But also the fact that the oil prices dropped from 50, 60-ish dollars a barrel maybe a month and a half or 2 months ago, and it was ranging there for a while. So businesses have built up their production systems and the means to get the oil kind of down pat. And if you have, let's say, a cost of $35, $40 per barrel to get it, and it's, let's say, $50 or $60 per barrel, well, then you're making a profit, and that's totally feasible of an operation. But now at oil sitting at, let's say, $22, if that same operational cost is at $35 or $40, well, then you're not going to be able to make money. If you're producing, let's say, 1 million barrels a day or even less, you're losing money every single day, right? So it just does not make sense to continue operating the business. So that's where a lot of these Albertan oil companies are at right now. They can't continue operations because they'll lose money if they do. So very tough situation. So Canada is getting a little bit of a double whammy here. Let's continue on. The move puts the overnight rate at an all-time low, last seen in 2008-09. So this is when the financial crisis happened and the real estate market took a dive in the United States. Let's continue reading here. Polos downplayed the idea of sending interest rates into negative territory, saying negative interest rates aren't sensible at this stage. What's big is at this stage. That means that they aren't going to they'll think about potentially having negative interest rates if this gets worse. We've already seen Germany, Switzerland, Japan, Sweden, a lot of these European countries have already implemented negative interest rates, and they're already doing massive amounts of QE and repo operations. Now, Canada is now implementing basically zero rates and quantitative easing. It's just a matter of, okay, are they now going to go negative interest rates like some of these other European countries? So we can see the central bank also launched 2 new programs. One will aim to alleviate strains on the short-term funding markets, while the other will see the central bank begin acquiring federal government securities in the secondary market within a minimum of $5 billion per week. What does this sound like? This sounds like the U.S. in 2008, right? They are acquiring federal government securities in the secondary market with some obscene amount of money coming in per week. It sounds like '08 in the United States. In a research note Friday, CIBC Capital Markets senior economist Royce Mendez said the introduction of a form of quantitative easing should help alleviate some economic pain and eventually support the recovery. So yeah, 100%. They say it right there. It's not a form. It is quantitative easing. It is. You're printing money and buying, as we can see, acquiring federal government securities in the secondary market. This is quantitative easing. Canada is now implementing artificially low interest rates at 0.25% from a 1.5% basis point cut, I believe. Let's just go to our economic calendar and go right here. Bank of Canada announcements at 9 a.m. today. If you click it, we can now see what it was and what it is now prior and actual. So the change, so the previous was 0.75 basis points, and now it is 0.25, a 50 basis point cut. And then we can identify the definition and read about it there. But as of right now, yeah, Canada's in the same boat as the United States in terms of what they're doing to try to combat this situation. So that is going to be the Canadian side. We're now going to go into the American side, and we're going to talk about here's how the Fed will support Main Street. I don't want to get too into it because, to be honest, I'm not an accountant and I can't describe every single situation of how they're going to break it down. But let's continue on here. The small and medium businesses are set to become the next target of the Federal Reserve measures to open up the flow of credit throughout an economy that has threatened to freeze up over the coronavirus pandemic, which has shut down businesses across the country. The Fed's lending facility will use the banking system, such as commercial lenders and credit unions, as a conduit to funnel short-term financing to businesses so they can help make payroll and stay afloat in the coming months when sales are reduced to a trickle. It is still unclear on what terms the banks will lend money to businesses and who will be eligible to borrow from the facility. So the big thing is it's a loan, and we'll talk about credit and the role of credit in a cycle, because if you are borrowing, you're going to have a cycle, and we'll talk about it very shortly here. Let's continue reading. Fed officials have declined to offer information on the exact timing of the program, but Brussels guessed the Fed would start channeling funds into the banking system in around 2 weeks from this Friday, based on its communications with officials from the U.S. Central Bank. Even though precise details still remain unavailable to the public, comments by Atlanta Fed President Raphael Bostic suggested the Fed's facility is likely to follow the format shown in the chart below. So this is the chart below. We can see the initial funds is right here, the $1 trillion facility to provide low-cost loans to help small, medium businesses, small to medium-sized enterprises impacted by the COVID-19. So this is the total funds right here. Main Street Funding, LLC, $1 trillion of liquidity to protect the U.S. economy and jobs. There are two options to go from this fund we can see. Option A, sell the performing loans to the facility, which is the bank, right? At or after origination. So you can just sell them straight up as a transaction. Or option B, hold loans on balance sheet and sell non-performing loans to the facility at the price to be determined. So this is just credit because you're going to put it on the balance sheet, and this is actually selling it. So this is credit and this is not, it seems like. The one thing I really want to kind of emphasize about this entire system is the banks are getting this money for absolutely free, if not like nothing in terms of percentages. And the U.S. small businesses are now paying a 2.5% rate. So even in this time of crisis, banks are still making 2.5% of money that's made from thin air. Like, why not just go from the $1 trillion or the fund straight into these small businesses and straight into these mid-sized corporations? This is a third party that does not need to be there. This is why the government is talking about a central bank digital currency, the digital dollar, because this situation costs too much money. We went over the digital dollar within the cryptocurrency market update, and the government discussing the potential for a easier, more efficient transaction for American citizens and for individuals going straight into a Fed account or a Fed wallet with like FedCoin and that whole new outlook on digital currencies for the Fed, right? That's option one. But we can see this is the traditional system that we're currently working with, where there has to be a bank, a third-party mediator, in order to conduct the transaction, and they take a part of the cut, 2.5%. And the money has to go from the main fund to the bank, and then it has to transfer to the small business. So there is fees for each step, and the business is going to have to pay 2.5% of whatever they borrowed. So this just, in my opinion, shows the lack of efficiency of the current traditional system that we have. And also, now to touch on the fact that it is a loan. It's not just free money, it's a loan. And now we're going to talk about credit and why the fact that because it's credit, like when the government says it's going to bounce, like the economy is going to bounce back right up on its feet. Well, these people are borrowing lots of money, right, to get through the tough times, so then they are able to just basically pay their employees and live another day. So, they're not making money right now. So let's just talk about credit. So let's say this is your productivity, right? Your productivity is going to go pretty linear. You work more, you work longer hours, you're better at your job, you're going to get more customers, you're going to slowly grow if you work on yourself, if you build skills, skills that are relevant in life that people want as a service. Your productivity and your overall value as a human being should be going up if you're learning from your mistakes and are just being a good person who understands that you got to learn and fail and grow to actually see this productivity linear line go to the upside, right? If you're lazy, if you are not going to be educating yourself and super complacent, it'll look like that. Your productivity curve is going to go to the downside. But any person who has ambition and motivation, their productivity is going to go like that, right? But let's say there's no credit. You can only spend as much as you make. So let's say you want to spend more money. You need to make more money. You need to work longer, be better at your job so you get paid more, or provide a service to the market that's able to provide more income for you. Basically, it's kind of like three options there. And that's harder to change, but it won't affect the future. So this is if there was no credit in the world, right? Pretty simple. Now, let's say we add credit to this equation. Now, let's say in life, let's say this is the x-axis. This is, let's say, your 20s, and this is your 30s, and this is your 40s, and this is your 50s, right? And if you have no credit, the productivity in your 20s is going to be usually less than in your 30s or in your 40s, because at these points, you have more skill, you have more abilities to make more money. But when you're younger, you have less. But now we're going to incorporate credit into this. Okay, now let's say when you're 20, you could either work harder to make more money so you could spend more, increasing your productivity, or you could just borrow money. Well, that's still borrowing value. You're not working harder, you're not spending more time at work, you're not producing more value, but you're just making more money for yourself by borrowing it, by creating credit, right? So let's say you're living your what's it called? Living expenses, or your cost of living, or your what's it called? You are, man, I'm forgetting the word. Where you're living, like your social economic standing, basically. The harder you work, the more money you make, the higher your social economic standing is, and that usually grows over time. But let's say you have a lot of credit, and you can now buy all this stuff with this value, right? So you're going to be living high right now, right? Because you are not making much money, but you borrow a lot of money, you're living high, all the way up here, compared to your productivity level, which is all the way down here. So you're it looks like doing great, but you now have a lot of debt. As time goes on, you're going to have to pay off those debts sometime, right? It could be 10, 20, 30 years, whatever. But during that time you're paying off that debt, you have to live below your means to pay off that debt. Whereas in your 20s, you could live above your means because you're borrowing. That was the word I was looking for, below and above your means. So when you are borrowing credit, you can live above your means. But that means you have to live below your means in the future. Because credit is basically borrowing future, not opportunity, but borrowing future value in some sense, because you're taking value from the future that you would have got and giving it to yourself now. And this makes sense. Credit is great if you are a farmer and you need a tractor, and that will increase your production cost, your production, which will give you more revenue. If you are building a business, if you are needing capital for opening up like a restaurant or whatever it is, that's usually a good thing because you're trying to create a business, a service that will pay you back. But the problem is, let's say you borrow money to buy a car just because you like BMWs more than your Honda Civic you drive, or you are wanting a brand new TV, or you're really, not really good with money and you think that Yeezys are going to be the safe haven asset of this next recession, right? So you can live either below your means or above your means. But when you have credit, you have to have a future point where you're going to live below your means, right? And this is overall economics as well as personal economics. We're at the high time right here for the global economic debt as well as a lot of personal, right? So if you're able to stick below this area, you're not going to get destroyed. But I hope that productivity level and credit makes sense, because if you understand that, okay, let's say businesses borrow funds right here, right? At a future point in time, their business has to live below its means, meaning they can't put more money into the business to make it grow. Maybe they want to spend more money on marketing. They want to hire more sales reps. They want to renovate the restaurant and get new chairs or whatever it is. They can't do that because they need to pay off their debts. They have to live below their means. So even if this whole economic situation and coronavirus blows over, a lot of these businesses will now have new debts, right? Because of the government giving them money for the short term, loaning them money, not giving them money, loaning them money. So once this thing blows over, there's still a lot of companies that are now having to live below their means. They can't invest in marketing. They can't invest back into the business. And this will, again, still continue the slow decrease of the GDP. So that's the reason I think that the economy is not going to bounce back right away. Hopefully you got a good understanding of that. I feel like I understand that situation. And if you have any questions, please drop a comment within the YouTube video or the Discord asking questions, and we'd love to help you out. So that is the news story topics for the day. We'll now go into the charts here. Going to get a little bit of coffee, but hopefully you were able to understand that concept. All right, so let's go on to gold. Did get an entry on here. Let's look at the 4-hour chart. We got a strong push to the upside. And like we talked about yesterday, it's just a matter of if this is going to be the lower high, or we're going to get that final push to end it off at 1700. And that's going to be our speculation that the price is going to push up one more time, holding the ascending level of support on the 1 hour we'll talk about. We already squeezed once and pushed to the upside, got our first impulse push, and we got a nice consolidation, gaining lots of buy volume within the consolidation. Strong VSA confirmation right there. Increasing buy volume coming into the market, seeing lots of bullish pressure, and the pullbacks are getting very little bearish pressure, seeing a huge discrepancy in demand versus supply. So we got a strong push after the reversal. Check out the previous global macro videos. Fucking perfect reversal call on that one. And then now we are getting our first strong uptrend. This is our first major consolidation. This is a reaccumulation phase in my view. And then we're going to get the next markup phase potentially to the $1,700 zone. It's just a matter if we're going to break the $1,700 zone or we're going to hold within this range and then create a channel. But that's just going to be the trade that I'm going to be taking on right now. Looking at the hour chart, let's just take a quick picture and then discuss the flow of the market after this really nice squeeze right here, like there, right? Very, very nice squeeze. We got a strong push to the upside. This is kind of our first accumulation phase or our first reaccumulation right here. So this is the accumulation phase where we're getting consolidation, holding between a resistance and support, and then we got push to the upside, making a market structure higher high, higher low. That for me was a solid breakout, and then we got a strong push to the upside, and now we're in our reaccumulation phase. This is the markup, and I think we're going to have another markup to around this zone here. So that's the overarching kind of market structure that we're seeing. Now to the price action, we saw a nice symmetrical triangle with an ascending zone here. We did break the recent high there, did get stuffed at that zone yet again for another resistance. So now we see a bit of an ascending triangle pattern with this ascending line right there holding the higher lows. We see a previous resistance, support, support, support. And it's just a matter of if we're able to push above to the next take profit area. So it's looking pretty good. We're making higher lows. The volume looks strong on a larger time frame. The squeeze push to the upside, that's giving me a decent amount of confluence and confidence that we could see another push to the upside. And this is a nice little pullback on the 4-hour, just validating the previous resistance as a new potential level of support, kind of like that. So that's gold. If something happens, obviously we'll have to shift our bias. If it breaks this ascending zone, we'll have to shift our bias. But as of right now, we don't really see anything else to add. It's looking like a pretty good setup. It's a 4-to-1 risk reward. And that is a risk reward that I'm very happy with. If it does break this ascending support, we will have to reassess. It could still be a nice continuation pattern to the upside, but as of right now, the overall structure of the market to me looks like it could just see another little push to the upside. We're seeing a lot of, we're seeing increased spreads, not a lot of trend, just straight consolidation, which is not necessarily a bad thing. We still are holding our ascending zone, so we're kind of getting in before the move occurs, hopefully. So we'll see if it goes up there. So if it does come down, we'll have to reassess. But as of right now, we don't really see a need to do much else. All right, silver is the next one. Remember on the weekly, very, very important zone for our trade. Key zone of support, which is now going to be a resistance, key zone of resistance, which is again another going to be a level of resistance. On the 4-hour chart, we see, remember that this 14/15-ish area is going to be a zone of resistance, not an exact area. We can see this is kind of, the price action is above the zone, but I'm very all right with this being the level of reversal. And then going on to the 1-hour chart, let's discuss the potential here and what we're able to identify. Let's get our snip. So we got our key level of resistance at $4 or $14.70-ish cents right here. 1, 2, 3, 4. So that's a key level of resistance right around here. We also have an ascending zone, not perfectly right around here. It's a little bit noisy, but we see our first nice touch of a support right here. 2, 3, 4, 5, and now we got to push to the downside, and now we're testing this as a new level of resistance, and it looks like it's holding. So that is what we talked about initially. I thought we were going to get a little bit more of a push, but at the end of the day, we did test these lows yet again, and now we're testing this as a key level of resistance. So if it breaks here, that's a confirmation of our ascending, that's a wedge, of our ascending triangle pattern, which would be like that, and then the price breaks, retests the resistance and the ascending support, which is a resistance, and that's a pretty high probability situation to move to the downside. And you also have to consider that this is a massive sell zone for silver because of the key level of resistance that we're currently at. So we're combining the price action pattern with the major market structure on the weekly and the monthly, so we're able to create more confluence for our trade. But as of now, market structure hasn't shifted. We haven't really broken the 14.40 range, or $14-ish range right around here, like this level of support that's holding on the 1-hour chart. So I'm currently not really looking for any trades just yet because the market structure has not shifted to a lower low. We're still holding our lows, so we're still in consolidation sideways. So I'd like to see the market move to the downside before we look to enter. And like we said before, for gold, we're looking more bullish. For silver, we're looking a little bit more bearish. So it's going to be a difference there, and it's great because we have opportunities on both sides, whichever way the market goes. We're kind of looking on both sides of the fence, which is not a bad thing to be doing. So having something like this actually would be a really good situation, and that is what we're going to be looking for, somewhere around there. So that's going to be the analysis for silver. We're not really going to be doing anything right now, but it's looking like it could be a potential setup. Overall structure of the market is looking good as well. Quick talk on the gold and silver ratio. It did move back a little bit higher here. We got the the weekly to pull back, and this is going to be a matter of if the monthly is going to hold and the daily is going to be just a wick out, or if the daily is going to hold here and we're going to start trending back again. Then that would mean that silver would take even more of a dump, because right now This is indicating that silver is extremely undervalued. We've never seen the gold and silver ratio at plus 120 in decades and decades and decades and decades. I don't know when the last time it was up there. I try to do my research and I just cannot find it. It's been a very long time, which means that silver is extremely undervalued. So that's the gold and silver ratio. Oil just taking a beating yet again. So we drew this ascending or descending trend line, my bad, a while back, and it's just been getting hammered on it. We haven't seen any real pullback from the buyers. We saw this one that got stuffed pretty easily right at a key level of resistance, and we haven't really seen a pullback yet. We got our anchor point right here, first touch, second touch, and we got this whole zone to get respected so well. And then we had our anchor point, one touch, two touch, three touch, had a zone of confluence, pushed down, pulled back, and dumped even further. So now we're testing the lows here that we had back in the 18th of March, middle of March-ish, around here. So now we're going to test these lows, and it's just a matter of if we're going to hold and then start to rebound back up to maybe a potential level of support, previous support, which is going to be new level of resistance, around 28 or maybe 25, 25.50. That's going to be a minor level, but I think the major key supply zone for oil is going to be around $28, $27, right around here. That's going to be the major supply zone that we see for oil. From this breakout, I do think that we could see a pretty quick climb from 22 to 28. So if you are trading futures or contract for differences or CFDs, that could be a potential opportunity from maybe 22s to 28s, because the market's just been absolutely beaten down. It's been in a bear trend, just making lower highs and lower lows for a while, and the market usually takes a breath after this descending zone is respected oh so well. We can see right here, we're just looking for that market structure and price action to shift. Volume, we're not looking for as much, but we're looking for some move to the upside here, and that could be a good contrarian trade for a counter trend long opportunity before we make a next bearish push to the downside from around the $28 zone. So that's my analysis for oil. Hopefully you enjoyed it. I think, if you're looking for shorts, I think it's a little late at this point. You're kind of getting the crumbs of the short. I think the next meat of the move is going to be after the pullback, and that's the same thing for the SPY that I think as well. So looking at this chart right here, I do think that we will get another pop up, and we'll probably test 27 or 2800 hopefully. This trend line is pretty well respected, and we're looking for something like this where we're getting, I guess we'll take a picture. We're getting a nice ascending zone to hold with multiple touches. We're getting that right now, so it's just a matter of if we're going to stop with the higher highs and then hold a level of resistance horizontally or a little bit ascending, that's totally fine. And then we're going to get that nice squeeze in the price, and we might see another dump kind of similar to what we saw here, where we got a high, could not break the higher high, could not break the higher high. We got a squeeze, and then we got a massive move to the downside. So simple market structure, we got push, exhaustion, and now we're going to get another push to the downside once that outline of the support gets broken. In that said, that's what we're going to be waiting for TVIX. And we already see a little bit of a break, but what we're looking for is a better confirmation that the resistance is holding. And I don't want to be looking to try to get that perfect entry. I don't mind waiting until we have a confirmation kind of in around these zones, but I want to see that break very, very clear before I make my choice. But TVIX is going to be a instrument I'm going to be using to try to capture some profits. So looking at the S&P, the S&P started falling in, let's say, late February. In around February 20th is when we started our first drop. And then March is when we just saw an absolute demolish market cap for the S&P. And we can see right here, March started on this zone right here. So the first move of the S&P, this top from 3,400 to 29, this first move is going to be this push right here, right? So that was that first push. And that moved a pretty staggering 200% on that one push. And then we got a pullback. This was the pullback. We got some hesitation. We got a pullback of around 24%, maybe around there. We held a support, and then what did we get? We got our next push down, which is massive. What did TVX do from this pullback? So when the S&P went from here to here, dropping 28%, TVIX went up from around here to around $1,000, so almost 900%. Let's say 880%. It went up from here to here. So now we're getting our pullback. So TVIX is now getting a market breadth where it's going to go back to kind of the mean, or where it's supposed to be to some degree, where we're seeing a lot less volatility in the S&P, which is exactly what we want. In an ideal situation, what are we looking for? We're looking for a slow inching climb up where we're getting lots of small pushes to the upside, not a lot of volatility, and a slow crawl. Not crazy moves, but a nice slow crawl up. And then once we break this ascending zone, then we're going to get the shorts to attack the price, the people that have bought in through the little bump up to get fearful, sell, and for the algos to just smash the price continuously down, because they're not really meant to be trading in these different market conditions, in my opinion. A lot of these algos were meant to trade in normal market conditions, quote unquote normal, for the last 8 years without any of this crazy shit happening. So I'm sure a lot of people in the algorithmic world have to be looking at how well their code is trading. But that is basically what we're going to be looking for the S&P 500. I think it's a pretty prime opportunity. If you're talking about risk reward, like let's say we get one little push up to maybe around 27 or something, we're hopefully going to get that price to come to around the $200 zone, maybe even the sub $100 zone, but I think 200 is going to be a pretty good entry in my personal view. I think that would probably be where the S&P would go up to 27. We might get a bit of drawdown if the S&P does actually reach 2,800 and get that little extension to the upside, but I do not mind because the risk reward on TVIX is fucking unbelievable. So let's say you get it in 200 and then you do get that push back up to 28, which you're not looking for, but you're willing to take on. Well, that would be, let's say, a 50% pullback or a retracement, or a time when you are not making money but still have the trade on. What you would call a drawdown in trading. So let's say your drawdown is max 50%. That's kind of going to be where you are going to call it quits, let's say. But your reward, if it performs like we saw last time, and remember, this is the first major push to the downside. In bear markets in 2008 and 2001, you saw a multi-leg bear market. It's not one push to the downside. There's a strong push, there's a retracement, there's a pullback. Another strong push, there's a retracement, there's a pullback. Same as a bull market. You get a strong push to the upside, you get a pullback. At a major resistance, you get a pullback, validating that resistance as a new level of support, and then you get a consolidation, and then you get to move to the upside again. So the market moves in waves, and we're going to try to capitalize on that. And for investors and for people who don't look at charts or people who don't know markets, they're going to get so emotional within these waves, and they're going to make their decision after the wave is already complete. So for example, S&P, right? By saying that we're going to go to the upside here is a bit contrarian because the overall trend is so much to the downside still. Once we're up here, then everyone else is saying, oh my God, we're up, like 14, 15, 20% from the low. We must have bounced. But they're calling that when it's about to fucking reverse. Because you've already seen it go up. You see the proof that it's already moving up. It's too late, my man. And the same thing to the downside. Let's say you're looking to short and you see it start to go down. Well, you're not going to get the confirmation that it's going to go there before it goes there. You have to take that risk. If you don't, you're going to enter way too late, like all the way down here. You're going to get the crumbs of the trade. Yeah, this is a great trade, and it could end off like major pushes usually end off with a full capitulation, breaking either greatly to the upside or to the downside, and then they retrace back. And that's kind of what we saw here. Here's the capitulation, and then we get a strong retracement or a pullback back up to the upside. And that's exactly what we're looking for, because TVIX hopefully will come back down a little bit more. I'm hoping it breaks the $300 support and comes back down to 200. That's going to be a prime opportunity in my personal view. But at the end of the day, we're not looking for a particular price. We're looking for what the price action is doing on the S&P 500. That is going to be the entry signal for us, not a particular price on TVX, but what the price action is doing on the S&P 500. That's going to be our entry signal. So that's basically it. Going to quickly look at the dollar index. Dollar is weakening. That makes sense. Stimulus package, massive inflation potentially in the future when things settle. So there's going to be a little bit of weakness. I do think the dollar strength is going to come back when we do have that next push to the downside and next leg down, but that's my personal view. Right now for the US dollar index, 103 is going to be the level of resistance that we need to break before any real major breakout. And if we're sticking below that, we're probably going to consolidate sideways for a little while. A lot of chop, nothing really entertaining to be looking for as of now, although on the weekly we got a massive amount of volatility, first initially to the upside after that liquidity event, and then now that the Fed is printing money and stimulating the markets and the economy, we're now getting a little bit less of confidence in the United States dollar. So that's basically the overview of the global macro update. Thank you very much for watching. If you thought this was useful, helpful, and you would like us to do more, definitely drop a like, a comment, and subscribe if you think that it will help you out in the future. So I don't have a lot more to add. Thank you very much. We will go over the questions within the TikTok and YouTube comments, but as of now, that will be the completion of the global macro update for our YouTube channel and for our Discord. So thank you very much for watching, everyone, and until next time, happy trading.